What if the financial tool everyone warns you about could actually be your strongest defense in a crisis? Credit cards, debt trap, or strategic shield? Credit cards in liquidity planning. Credit cards in liquidity planning can provide immediate payment flexibility during emergencies, but they must remain a temporary bridge rather than a substitute for savings. Their benefit depends on having enough liquid money to repay the total amount due before the deadline and avoid finance charges. Credit cards in liquidity planning work best when every purchase is supported by money already available in a savings account, sweep facility, or suitable liquid investment. Before using a card for an emergency, confirm the billing date, payment due date, available limit, merchant acceptance, and expected redemption timeline of the asset that will fund repayment. Set automatic reminders or autopay for the total amount due while keeping sufficient balance in the linked bank account. Review statements for unauthorized charges and avoid converting emergency spending into a long tenure EMI unless the complete cost is clearly understood. Most importantly, test your plan periodically. Credit cards in liquidity planning should support cash flow timing, not create permanent dependence on borrowed money. Credit cards in liquidity planning. Strategic financial shield or debt trap. Dated 30/07/2026. Credit cards are often viewed with skepticism, characterized as easy gateways to debt traps and impulse buying. However, when integrated into a structured liquidity plan with discipline, a credit card is one of the most powerful liquidity tools available in modern personal finance. The key to mastering credit cards lies in understanding their true function. A credit card is a payment bridge, not an emergency fund. In a financial crisis, speed and convenience are paramount. Here is how a credit card acts as your primary layer of defense. Instant 24/7. Execution. Hospital admissions, emergency travel, or critical repair fees don't wait for business hours. A credit card provides immediate cashless settlement when bank branches are closed or fund redemptions are processing. The 30-50-day interest-free window, redeeming money from mutual funds or breaking fixed deposits, can take 24 to 48 hours. Using a credit card buys you up to 50 days to initiate asset redemptions calmly and settle the bill without paying a single rupee in interest. Preserving working capital. By routing routine purchases through a credit card, your actual cash remains in high-yielding liquid accounts or sweep-in deposits for an extra month, earning interest until the bill due date. While credit cards provide transactional liquidity, they cannot replace actual cash savings. Confusing credit limits with capital reserves can prove disastrous during economic downturns. Maintain a dedicated emergency card. Keep one credit card with a high limit completely clear of routine online shopping. Treat this card as your Tier 0 reserve, ensuring 100% of its limit is pristine for unexpected crises. Keep utilization under 30%. For regular monthly expenses, avoid utilizing more than 30% of your total limit. This keeps your credit score healthy while preserving the remaining 70% as emergency capacity. Never use credit card cash. Advances, cash withdrawals at ATMs accrue interest from day one without any grace period and incur heavy fee charges. Always pay the total amount due. The liquidity benefit of a credit card only holds true if you pay the total amount due in full before the due date. Paying only the minimum due triggers exorbitant interest charges across all previous and new transactions. A resilient liquidity strategy pairs credit cards with liquid mutual funds and auto sweep accounts. The credit card delivers instant payment agility, while your liquid investments provide the financial backing to settle the bill in full, giving you ultimate peace of mind and cost-free security. This article was drafted with the assistance of AI and curated for accuracy and relevance. This article provides general information and it's not financial advice. We are not SEBI registered investment advisors. And this content does not constitute investment advice. Consult your financial advisor before making any investment decision. Anchor text: RBI credit card billing and interest-free period rules. RBI credit and debit card FAQs. For more information, contact us. Let's recap the key takeaways about credit cards and liquidity planning. First, credit cards provide immediate payment flexibility during emergencies, but they must remain a temporary bridge, not a substitute for actual savings. Second, they offer a 30 to 50-day interest-free window, giving you time to redeem assets calmly without paying interest. Third, maintain a dedicated emergency card with high limit and keep your regular utilization under 30% to preserve emergency capacity. Fourth, always pay the total amount due in full before the deadline to avoid exorbitant interest charges. Finally, pair credit cards with liquid mutual funds and auto-sweep accounts for a resilient liquidity strategy that delivers instant payment agility with financial backing. Thank you for watching. Remember, credit cards are powerful liquidity tools when used wisely. Stay disciplined, stay informed, and keep building your financial resilience.